All right, all right, all right. Good morning, traders. Welcome to this live intraday strategy webinar. Today is Tuesday, March 15th. Mike Boutros with you on the horn. Hey, Agnes, Aurelian, Steve, Ted, everyone in the room. Not going to get to everyone, but great to see you guys this morning. We are pre-FOMC, okay? The FOMC interest rate decision is on tap tomorrow. Later, just a few days later, guys, we do still have other interest rate decisions as well, specifically from the UK and the BOJ. That's heading into next week. So markets are about to fall in that pre-FOMC lull, where we get a little bit more of a range, contracted price action, but there are a lot of levels to look at. So guys, on the list for today, we'll start off as always with DXY, Euro, from last night, Aussie, gold, and a look at the 10-year, which I don't know if you guys were in the webinar yesterday, but when it ripped, it actually caught resistance at the upper parallel, which is interesting that we're seeing that pullback today. Nonetheless, we'll look at the implications of what that means for dollar yen. And on the dollar yen breakout, that trade also exhausting into near-term resistance. We'll take a roundabout look at all the equities. Excuse me, SPX, NDX, the Dow Jones, all at support today. Some really important price action as we get into that FOMC rate decision tomorrow. And a quick look at silver. Okay, any other questions or trade setups? As always, feel free to throw them on the message board at any time. A quick reminder, guys, this is the FOMC's page. You're gonna wanna keep this one handy tomorrow heading into the release. Let me put the link right in there for you. Okay. So you should have a link for you there right there. You'll see it pop up right here. The page is a bit backwards. I don't know why they format it like that, but our last quarterly update was back in December of last year, 2021. You got to go all the way to the bottom to the December read. And here was the last projections, right? So I went over this briefly with you yesterday in the webinar, but again, the major things we'll be focused on tomorrow, the personal consumption expenditure, again, that was upwardly revised from 4.2 to 5.3 in December. More importantly, core PCE was also upwardly revised from 3.7 in September to 4.4. Guys, these are both going to move up. It's the magnitude of how much it moves up that we'll be paying attention to. Okay, so if the 8%, 7.9% CPI read we got last week put some more weight, put some more emphasis on the inflationary figures, increases the Fed's expectations that we are going to see prolonged higher inflation, you're likely to see both of these rise. And what does that mean for the interest rate dot plot? This is what everyone gets to focus on as we head into the release. I went over this with you yesterday. I don't want to waste your time again. Keep your eye on the nominal rate or the terminal rate, longer running rate, whatever you want to call it. Where baseline at 2.5 is pretty much where the majority of Fed members sit. And then obviously we'll see what kind of deviations we get to the 2022 expectations, specifically with the fact that markets now are essentially pricing in 25 basis points tomorrow and 25 basis points at every single Fed meeting this year. All right. So the expectation is there. What their drag is again balancing that act between equity markets, which look like they're about to turn over. Obviously, the Fed's not quote unquote supposed to be looking at equity markets, but there it is. And then you have a spiraling inflation. So they have to strike that medium balance. You've got a raging war, which again, for all intents and purposes, guys, not to be alarmist, World War III has started. We're basically at the throes of it. And if this does get into a protracted, longer, larger global sort of catastrophe or conflict, things are going to put even more strain on the economy. And can the economy handle higher rates? So we are in for a doozy, guys. This is honestly, I don't see how the Fed could strike a balanced post tomorrow. That's just my humble opinion. They're damned if they do. They're damned if they don't. Too hawkish, and they're going to skid out the market, which is already turning over. Too dovish, and they risk inflation really ripping this apart. It's interesting. A lot of the people, not to get political, forget about that comment, but I just want to say a lot of people who are, economists and all the commentary you see today, they weren't around. They haven't seen what really hyperinflation can do to an economy. Again, not to sound alarmist, but that's the balance act that the Fed is going to try to stand to balance tomorrow. And really, how the markets buy that, whether they buy it or whether then you guys are full of, what, that's what's going to determine the market action. So let's jump into the price action and see where we are on whole. So here is our last update on the DXY was way back here on the 6th, and this is what we were looking at, right? The DXY had already broken key resistance. That was 97.70, 98.84 was the initial target. The 786 retracement was at 100 proper, right? 100 spot 04. Didn't quite get there. Here's what the daily chart looked like with the breakout again of that key region, 97.70, 98.84, and then we got hung up on the slope. So we didn't quite make it to 99.66, didn't quite fail at the slope. We kind of probed through, and then we pulled back, and we've been in this range ever since. Here's the daily chart right next to it, right? Again, weekly, I showed you this yesterday, there's that longer term slope, right? Let me zoom this all the way out to that 2011 low. There's the origin of the slope. Here's the parallel. Support, break, now resistance. So the propensity to see some pullback, we noted that yesterday, and we're getting it. I don't want to get too comfortable with that notion, but that's basically where we are. We're at uptrend resistance. Again, the daily chart shows us in a contractionary range, it looks like. So we made a lower high. Do we make a higher low along that slope? Would basically put this whole thing in sort of a near-term contractionary range. Again, top side, 99.66, 100 proper, that's huge. Then 1 spot 49, 79. That's the upper parallel. Near-term support is at the median line. Bullish inval is right back at that major support zone that we were resistance zone, that we were looking up on the way up. Last month's high, that's 97.70 into 97.80 and change. Here's what it looks like on the near-term charts. No fun so far this week. Really tight contractionary mode. Here's what the 2-hour looks like, right? A little bit of a slim lower. But heading into the FOMC, again, a trade that is near or at uptrend resistance, meaning if they come out rather hawkish, okay, even if the dollar rips higher, you're still at resistance. I wouldn't want to get too, comfortable unless we solidify a close above 100. So even if this rips higher, guys, 99.66 and 100, watch both of those levels for possible exhaustion. It still might be a decent fade. Remember, markets have priced in these rate hikes. The question is, does this upset the rate hike outlook that most traders, most economists are sort of working with at this point? Questions on DXY? All right, let's move right on. Next up on tap, let's hit euro dollar number 2. I gave you guys an update on this last night. I didn't take anything on this. It was actually an opportunity yesterday to try to take a small long position, but I just missed it. Lots going on my end. But here's what it looks like on the update from last night. So the big focus essentially was this hold right below the median line. We pulled back. We turned just ahead of the 75% parallel last week, pulled back. Here was the median line resistance. Our focus, as we said in the webinar, is to look for a high, for an exhaustion, either ahead of 111, bearish inval, key resistance 112.20. I don't think we get quite that high, but we're looking for possible exhaustion off of downslope resistance. Again, the break below key support, which is still 108.13, 108.14, is exactly where we caught the low. That's what we need to get the onset for the resumptive move lower. That's if the dollar is going to hold strength on this move. Again, FOMC could be the catalyst that we need to sort of get this thing going. Hasn't been much of a fun trade so far. Sort of boring on both of these pairs, but most of the action has been elsewhere. Keep your eye on this. Just wanted to highlight this 618. That's sort of a level I was looking at also. That's the Friday high. All right. Base case scenario, we're looking for topside exhaustion. So what I was telling you is last night or yesterday, there was a decent this pullback early in US trade, right? Stop against the low would have been the play. Even when it rallied and pulled right back into Asia, stop against that low would have still worked. You'd be in the money right now, a good 30 pips, 40 pips. Too tight, you know, I didn't want to sit here and try to squeeze out pips out of a tight trade where the ATR is not that big, comparatively speaking to what we've been looking at. So maybe a little bit of drift higher, right? Maybe 110.37, maybe 111. I would look at that parallel ahead of that. But essentially, we're looking for exhaustion on the upside to the next move lower. Questions on euro. Bearish inval is 1230. If we get through 1230, all hands off. You've broken out of the near-term downtrend. At that point, you'd start to look for a larger rally in price. All right, so that is DXY and euro, number 1 and number 2. Number 3, Aussie. I like this trade a little bit more. Big support. We talked about it yesterday in the webinar. It's working out well. Here's Aussie. Remember, we're coming off of on the weekly charts. Huge reversal last week. Really nice touch of a critical zone of resistance that we've been watching for quite some time. Last night was just it was a sweep, right? So we talked about resistance at 73.65, 73.85. You have the 52-week moving average. You have that major pivot, again, from the May 2017 low week close. You got a 38.2 of the decline off last year's high, again, on a closed basis. Just beautiful, beautiful, beautiful. Resistance ahead of 16 momentum. So all things held constant, you know, we turned from downtrend resistance. So that would suggest if we break that 618, you're looking for the resumptive move. Now, yesterday pulled right into that slope. There is a near-term retracement. I'll show you an extension on near-term charts I showed you as well. Was worth a little bit of a bounce for me, but that's it. We're right at trend extremes. This is the weekly chart, so nothing matters here until the weekly close, but I just wanted to show you where we are in the broader scheme of things. Here's what Aussie looks like on the daily chart. Okay, and here's what it looked like last night. Got deeper than we wanted with that with the 25% parallel there, but the exhaustion trade near term, again, I'll show you the levels, looks like it's worth a little bit of a bounce. Key resistance is still 72.60, 72.70. This was a big turn, guys, from downtrend resistance. Again, I can't stress where we're coming from. This also, in my mind, is reflecting a false break or a yearly opening range reversal. Remember, here's your January high, here's your January low. We spent February in that range. A breach higher essentially is a breach of the quarterly opening range, let's call it. You'd be looking for that late quarter high. Reversal, break right back below the objective yearly open. Really puts a damper on this. Really puts a damper on this. And basically threatens resumption of the broader downtrend if we break below that parallel. So little bit of a bounce was the game plan here. Again, 100% extension, so 2 equal legs off the high gave you 71.74. 71.71. Here's what it looks like on the 2-hour, right? So worth a little bit of a bounce. You know, I put a trailer on that if you're holding that still. If not, basically, I mean, you're looking to fade out ahead of 72.60 for sure, but was a nice little bounce. So we're basically, what, almost 40, 50 pips off the low. Wouldn't get too comfortable with it. Drop that 50 at this point. And tack on a quick retracement like this. Ooh, look where that 38.2 is. Too clean. Just let me see what a basic 236, we're probably there now. All right, keep that on there. Keep that on there. Beautiful. All right. So there's a huge cluster, even more now, at 72.60, 72.70. That's your threshold. If this is going lower, I don't want the recovery to get anywhere beyond that. Okay. Um, Ultimately, 73.13 would basically be resumption. That's a breach above the median line. It's a breach above the January highs. All right. So maybe a little bit higher. It all jives well with the dollar pulling back a little bit from uptrend resistance. Aussie rebounding from a nice measured move just ahead of that 618. Again, I think you do get the drive down lower, but right now, look to fade out of that long position. Any questions on Aussie? Now, tomorrow, interestingly enough, after you get the FOMC rate decision and the accompanying press conference, guys, that's at 2 is the rate decision. At 2:30 will be the press conference with Jerome Powell. Later that night, tomorrow night, we do get the release of Australian employment data. It's supposed to be a print of 37,000, effectively bringing down the unemployment rate to like 4.1. So keep that in mind if you're trading in the Aussie heading into tomorrow night, right after the FOMC, you do get that employment print out of Australia. All right, that's number 3. Number 4, here is a look at gold. And what a pullback. What a pullback. Hey, Ty, Naz, S&P, crude, gold, and silver, all on the list, buddy. You got nothing to worry about. Got you covered. So gold, gold, gold. Everyone's talking about gold. Why is gold pulling back when there's a war? What's going on, Mike? Well, every trend has its extremes. Every breakout has its exhaustion, okay? We turned just dollars ahead of the record highs at 2075. Here's the weekly chart for gold. Here's what it looked like just last night, highlighting key support for this broader trend. We talked about it in the webinar as well. Basically here, 1903 is the high close from last year. 1923 is the 618 of the entire drop from the record high. So still a major pivot zone. We're there now. We're there now. This is the weekly chart. Watch the weekly close with respect to this zone. If we break below, it's bad news. It's a larger corrective move, in my opinion, for gold. But right now, the objective is, the focus is inflection off of this critical range. All right, so be careful here. Gold on the daily chart looks like this. I'll be publishing a piece on daily FX, I think at 1 o'clock today. These are the charts I'll be putting on there. Big, big region right up front, 1920 into 1923. And again, remember 1903 on the weekly chart, 1908 here is the objective monthly open. And just lower, just below 1900 is basically uptrend support. So again, loosening up the levels a little bit to get a little bit closer view of what's happening in price. This is pretty huge. This is pretty huge. Intraday looks like a slow draw lower. Again, it's not the nicest setup. Like the levels don't look all that nice. We don't have a crazy dope slope per se. You know, you could try to tweak it. I was looking at this. I don't want to get too much crazy about it because it's a little bit of a liberal take on slope here, but basically it would suggest to break below here. There's 1900, there's 19, just below. Again, I'll take you to the daily chart, like right around here. Look where it is on the daily chart on the right. So that's the risk, guys, if this buckles here. There's a lot, yeah, there's a lot there. So it's the 38.2 of the advance off last year's low. Again, the 618 from the decline off the record high. And it's last year, the 2021 high day close. Okay, that's what that 1920, 1923 level looks like. Monthly open, key support. Now again, like I said, every trade has its exhaustion, every trend has its extremes. Is the geopolitical backdrop such where we're not going to get haven flows? No one believes the war is getting worse. It's all good. No, but this is where retail gets chopped up. where the market will correct and pull back way more than the markets were expect. People will start being like, oh no, this trend is reversing, and all of a sudden they start dumping their long exposure, accelerating the drop, but that's usually a decent area where the washout happens. So if we break lower, again, I'm still looking for an exhaustion low, but it just got too hyped. It became too much of the, oh, buy gold, oh, buy gold, oh, there's a war, buy gold, right? That sentiment will crest. And I think that's what you're happening. As that sentiment crests, you'll get a rally, hopefully, here in gold. Always remember, guys, whenever we're looking at charts, we're looking at mass psychology, right? So you can kind of tell a story. You can see where the markets are at, especially on a trade which is this ripped, right? I think that was like a, what, 8, 9 week advance? 1, 2, 3, 4, 5, 6 week advance. Pretty radical. Pretty radical. So it's going to be a similar scenario on silver, and I'll hit that in a moment. But excuse me. First, well, you know what? Let me just hit silver for you now, since we're in the sort of commodity block. Here's silver on the week daily chart. And our last update on silver, my friend, was right here. Okay. So weekly, we had talked about the 618. It was a perfect kiss, okay, of the 618 from the drop off the record high. There's the pullback. We're now sitting at the 52-week moving average. This was last, forget that. That was just a pivot high. We're at support. All right, Ty, this is an important level. Daily chart looks like this. This is the January high day close. This is the objective March open. This is uptrend support. You're looking for a reaction here today. You're looking for a reaction here today. The monthly open actually comes in at 24.44. 24.46 is the high day close. And again, that slope is right there. Here's what it looks like on the near term chart. 240, give you a better view. And here's what it looked like for us. Again, earlier in, this is last week. All right, we talked about the exhaustion high. We talked about the pivot right here. And if that pivot breaks, key zone. Now we opened this up, I cleaned this up a little bit. So here's the high, right, which is what's signified right here. And I had a big zone here. But once you made another sort of crest and then drop, now you have the opportunity to measure the move. And the extension of the high, low, high gives us 24.40, which is just below that. So I opened it up to right here, this zone, 24.46 into 24.40. Again, that contains the objective monthly open. So big spot tie right here for silver today. If you break 24.40, there's really nothing to stop 23.50s, 23.37. The measured move, the 1618 off the high would give you 23.37, a 618 off the low. Also 23.53 uptrend support. You got another slope there heading to the, this is into next week essentially. But you get the picture, right? Key support near term. Initial resistance is 25.40. You need to close above 25.87 to mark the resumptive move. Make sense? So that's number 5 for silver. Okay. So I do want to cover last night's piece. I just wanted to put a note on this because of how crazy accurate this has been. Again, you can't make this stuff up. So yields, we talked about this yesterday. Okay, we talked about 21.14. That was yesterday's high. We spiked higher today, failing at the upslope with a close nowhere near 21.14. Okay, we closed down at like 21.13 and change. So again, just a moment of pause to say, hey, you know, even the extreme in sentiment, even the extreme that we saw in yields in treasuries, right? Treasuries down, yields up, is sort of starting to materialize here. You're starting to see an exhaustion. You're starting to reach trend extremes. All right. So also a tail to tell alongside what usually moves very closely with this, and that is dollar yen. And here's the breakout in dollar yen, also beginning to falter at its uptrend resistance. Too clean for comfort. Here's what it looks like on the weekly chart. We started talking about this yesterday in the webinar as well. Well, we're breaking 118, 1790 was the December 2016 high week close. But all I said yesterday was watch the weekly close. We got upslope here on the weekly chart, pretty problematic. Dig in deeper to the daily chart. And if you take that same pitchfork we've been working with off the lows from 2020 and 2021, literally all through last year, a parallel of that slope extending off the high from October, hit it in November, just missed it in December. We're there now. We're there now. So again, a near-term pause, if you will, an exhaustive move, a reset for some of these breakouts, which have just been so phenomenal. Now, I do want to note that this is the largest breakout in RSI that we've seen since the beginning of the year, which was a fadeable event. Prior to that was back here. That just saw literally a single day pause before continuing higher and eventually making another high. Point being, this is dollar yen. Expect the abominatory moves. At the end of the day, near term upslope resistance. I don't know how deep the shallow gets, but or how shallow the pullback gets, excuse me. But here's what we're looking at near term. This is a pitchfork we've been following just from the November, December lows. Support, a little bit of play along the median line, breakout. That's the upper parallel. Now, if it would be too freakishly clean, right? But for the bulls who are still holding on to this is a break of resistance, a pullback into former resistance as support. If that low holds, a break of the highs, and you're going to see another rip, okay? If we close back below this spike low we just made, you start to look for a move at least towards the weekly open, right? Be very very light if you're going to get this ballsy, for lack of better words, excuse my French, on a trade, because again, this is a ripper, guys. It's still going to be a ripper, but we're at uptrend resistance. And so near term, you may see, if not a larger pullback, at least some sideways action. And again, don't believe me, hell, treasuries are there too, right? DXY is there too. I mean, we could go through the list. So a quick look there at the dollar yen levels. That's number 6 and 7. All right, here's the equity crunch. All right, we're a big support. The Fed's on tap, and this is kind of your worst case scenario, because even if you do get the break, guys, like, are you really going to trust a break of major uptrend support right ahead of the Fed? I wouldn't. So I'm kind of locked. I'm shackled. I need the Fed to kind of clear out the noise. I don't know. It's just a catalyst that's going to give us the break. And it's either going to be a larger recovery. They're going to come out super dovish. Oh, guys, this is blah, blah, blah. And that might give markets some solace. Or they might be a little bit more dreary if the economic projections show that there's a market increase in the expectations for higher inflation this year. That could also be a hamper on the markets. I don't know how this plays out, guys, but what I do know is that we are in a technical posture heading into that release that is so critical, so critical. Weekly chart for SPX. I mean, we're at slope support. We're at slope support for the last 4 weeks. From even a lateral level, we haven't broken support, right? So this thing is primed, guys. It's primed for a move over the next 2 days, and just be prepared because it might be pretty volatile. Here's what it looks like on the daily chart. And here's our last update here on SB. Okay, remember the weekly chart? Again, this was published back on the 13th. We were still highlighting that same slope. We're still holding it. Daily chart, well, that red slope, here it is. We closed there yesterday, drew lower in overnight trade, and here we are back above. Again, on a closed basis, it doesn't get much cleaner than that. So we're at support, okay? FOMC is on tap. You got clear resistance at 43.13. That's your breakaway. That's your breakout zone. Anything sub 41.17, and again, the measured move that we talked about all the way back here was 39.95. And that would be essentially your drop down zone. 40.35 soft target, 39.95 critical support. So we'll see how this pans out. We'll see how this pans out. Here's what it looks like on the intraday, and again, a look back at what it looked like a few days ago. Perfect kiss, perfect touch. We talked about that 618, the January close low. What a perfect touch of downtrend, excuse me, resistance. Here's the move lower. Here's that broader uptrend. Watch the crunch. Watch the crunch. Questions on SPX? It's the same exact trade across the board. Here's NDX. This was what it looked like on 13th. Here's what it looks like now. A little bit more forward leaning. I feel like, well, obviously NDX actually has been leading. So if this break is legit, right? Two areas of support we were looking at. There's that 764. There's that 38.2 or 786. Excuse me. There's that 38.2. 12,947. Again, that's for all intents and purposes the same level on SPX. 12,947 is akin to 41.17 in SPX. Those are the key support levels. So if we get below that, the next major sort of cluster of lateral support and slope converges down here. That's 12,204 into 12,439. September 2020 high, 100% extension, 2 equal legs off the high in the October 2020 high. Two-hour on the S&P. Yep, I showed you. It's right here. Oh, this is the 4-hour. You want the 2-hour? Sure. Okay. You got it, Ty. Says thank you. So again, and then there's the NDX for you at 2 hours, a 2-hour scope as well. So look, yeah, we're flirting with the break of the high. So listen, all of these retracements right here are based off this low. So as we're breaking it, you can kind of scratch this. It doesn't really matter because we don't have any major levels lined up with that retracement per se. Key resistance for us is still 14,041, 13,948. Okay, that's still key resistance. All right, and that's NDX. Finally, from the equity front, number 10 is Dow Jones. It's the same exact position, although this has just been flirting with a radically crazy support zone that it has not been able to break. Here's Dow Jones on the weekly chart. So you can see, you know, the slope maybe doesn't have so much merit, but we're right there. Resistance and key resistance is still at that 52-week moving average, which converges on the median line. My point being, we already dropped into this key zone of support. This is critical. 32,021 to 32,530. That's the end zone that you need to get through to mark a bigger break. Now, near term, it does look like a better coil, for lack of better words, or a better consolidation. But the same levels are apparent here. For me, the problem with this is, like, even if it breaks 32.5 and you get a decent run, you know, that's still key support, and that's not too much beyond the lows that we made in February. So little bit dicier here, but for all intents and purposes, Dow would need to break 32.21 to mark the next leg lower. There's really nothing until like 30.50, 30,500 at that point. Key support. Near-term resistance, breakout. All right. Here's what it looks like on the daily. Chop, chop, chop. Okay, and that's Dow Jones. That's everything on my list. Let me know if you have any other questions or specific trade setups you want to get into, guys. Other than that, we'll kind of wrap it up. Crude, don't mess with it. We're at support. We're at support. We went over silver, Ty, right after gold. Crude is. I love where it turned. I just don't know what to do from here. Here's crude on the weekly charts. This is so crazy clean. No one can believe the reports that we've been putting out on this. The high, literally 29.90. The close of the week, calling the exhaustion before we even opened. It was a very, very clean move. Very clean move. I have us at support. Now, on a drop like that, on a washout of that magnitude, on a trade that has so many headlines, so much geopolitical risk, you have to be very mindful of the moves. If I were in a normal trading scenario, normal trading conditions, I actually like fading the low here. Okay, a little bit riskier in the environment we're in, Ty, obviously, but former uptrend resistance turns support, right? The only other thing is I wish I had a retracement. I always tell you guys, I hate using this retracement because this is the zero print. And that's not really, it's not really a proper call on price. The actual print went like negative 40. So let's say we take a little bit more of a conservative approach and just take the most recent rally off of that, what was that, November, December low. In that case, we've already paired half of it, 95.90. So we already took half the move back. It's at former uptrend resistance. Could be a place to base. Again, very gutsy call, but that's kind of where I'm at. I'm thinking this kind of bottoms right here. It's too easy of a trade though. It's too easy to trade. I don't know why I'm uncomfortable, to be honest with you. Here's basic trendline support. Deux, trois? Is that the third one? Well, it's also the monthly open, right? All these things start to come out like, wow, maybe this should be it. Look, Ty, it's either here. I told you guys yesterday what? 96, 95, 84 was the open. It's either here or here. So that's my problem. You could drop another $10 before you start to run into the January 2010 high, the 2013 swing lows, nice decent pivot in price, major break, right? So I'm looking for an exhaustion low. I'm looking for an exhaustion. It's either the one we just made right here, or if we do get one more drawdown, I'd be looking to buy again here. But I think we see higher. Make sense? Yeah, I tend to be very cautious on these really, really stretched out trades, especially, crude is the talk of the town because of what's happening. The massive oil depot in Europe called Russia. This is too much in the headlines for me to get too critical with trying to catch every tick. Again, pistol to my forehead. I think we just bottomed. He says, makes sense. All right, thank you. Hey, you're more than welcome, Ty. It's always a pleasure. All right, guys, if there are no other questions, we'll go ahead and wrap it up here. Listen, keep it light heading into tomorrow. I do think you get some fireworks because, again, we find ourselves in a scenario where the spread, the expectation for rates is so stretched. You got people calling for 7 hikes. You got people calling for 50 basis point hikes instead of 25. The Fed's likely has already telegraphed that it's not out of the realm to go 50 if things are that bad. And that's really what we're looking to gauge. How bad do they see it? So the devil's going to be in the details of the conversation and the presser with Jerome Powell. The 25 basis point inherently is already priced in. So I don't think you get to move at 2. you'll want to look at the economic projections and the commentary at 2:30. In that time span is when the market gyrations will really start to get pretty wicked. I'll try to keep you updated on Twitter as always. And guys, best of luck trading. See you on Thursday morning. Quick note for everyone in the room also, I am scheduled for surgery next Monday, so I'll be out for a few days next week. God willing, won't be too long, but I just wanted to give you some heads up on that beforehand. All right, see you guys on Thursday. Cheers.